Does it really matter who ultimately will be as Fed chair, since it is one vote, an important vote?
But yeah, so, we've had to, as this news evolves, write just about everybody that's a front runner. So we wrote a Hassett piece before, months ago. I think we were talking about Governor Waller and why we thought he could have been a very good candidate for Fed chair. But to the question of does it matter? I mean, the market is pricing it like it does matter. There's a premium in the June FOMC meeting. We're building in more rate cuts at that meeting than the surrounding meeting. So the market is pricing something happening as that transition takes place. I think we're a little bit more skeptical of how much it can matter. Clearly, I think Chair Powell has mattered recently. I think you don't get the December rate cut without Chair Powell essentially pushing it through what is a very hawkish committee at this point in time. But I think he built up that confidence, the credibility within the committee over a period of time. Just somebody coming in from the outside with a more dovish view is not going to be able to get this hawkish-leaning committee to cut rates aggressively up front.
Of the candidates who are the reported front runners, is there one who it would send a signal to you, or maybe send a signal to the markets, that the Fed's independence is at stake?
Yeah, I think that there's lots of questions around this. I think when you kind of see surveys, Kevin Hassett raises some of the most concerns around Fed independence and kind of commitment to get inflation back down to target. And I think that's somewhat quite natural. I mean, he's been in the president's orbit for a period of time here. He's been an economic advisor for the president. He's been calling for aggressive rate cuts at this point in time. All these candidates are doing so at this point, as we heard from Governor Waller recently. And so I think whoever it is, the next Fed chair is going to have to earn the market's trust that they are going to commit it to bring inflation back down to target. And I expect the market to challenge that a little bit.
Hey, Matt, the New York Times writes, next Fed chair in a no-win scenario, a selection process draws to a close. And they go on to say the person picked to replace Jerome Powell will be thrust into a credibility problem that will be difficult to escape. Is that the case? And I also wonder, sometimes you get into a position and you realize the weight of a position. And we know what the Fed does means a lot, not just to the U.S. markets, but to global markets.
Yeah, so I think it is the case that there's going to be a challenge for this next Fed chair coming in. They come in almost with a mandate to cut rates meaningfully. The president has called for the Fed funds rate to be down close to 1%, near the lowest in the world. And yet, even though Governor Waller said that inflation is under control, core PCE inflation is at 2.8%. It's still 80 basis points above their target. We're now 4.5 years in well above target inflation. And although the market's pretty sanguine about the inflation outlook, we do have a stronger growth outlook next year. We have fiscal stimulus that's coming through the pipeline.
Sounds pretty good to me.
It actually looks like a pretty good outlook from a growth perspective. And then a question of, does that feed through into higher inflation pressures?
What about the labor market, in your view? We got some data yesterday. It was weird to say Jobs Tuesday over and over again.
It was.
It's partial data, and we'll get some inflation data tomorrow. But the jobs market, how does it look into you?
So the way we've been describing it, and I think yesterday was another case of this, it's a Rorschach test for how you think about the labor market. Each of these reports has good elements and bad elements. I think yesterday's report had strong job gains. It had a broadening out of job growth. We've seen the private sector rebound. We had negative job gains in June. Past 3 months have been 75,000 plus in terms of private sector job growth. So that's all quite solid. The weakness was in the household survey. You saw the unemployment rate rise to 4.6%. Broader measures of labor market slack actually picked up more. I think importantly at the December meeting, Chair Powell highlighted why we should discount that data. It's coming right around the government shutdown. We thought that there was going to be distortions to that household survey. So Fed pricing hasn't really moved all that much on the data. I think far more important will be the December jobs report that we get in early January.
So the worst case scenario is we've got inflationary pressures, which sound like they could be coming in the new year because of some of the stimulus measures that we're certainly getting from the White House, Matt. But if we have more inflationary pressures, but we continue, if we get some confirmation, the December numbers, that yes, indeed, there is job weakness and maybe it's continuing, that's a tough predicament.
It is. I think it's a direction of travel towards stagflationary type impulses for the economy. It is what most economists and we thought you would get out of very large tariff increases. And so I think it is beginning to work its way through the economy. I think what we've learned, though, however, is this Fed under Chair Powell and undoubtedly I think the next Fed, if you have weakness in the labor market, they will respond. They responded last year by cutting by 100 basis points. They responded this year by cutting by 75 basis points. Our base case is that the labor market stabilizes enough over the next several months that the Fed does not cut in the first half of the year. But look, if you get confirmation that the unemployment rate is 4.6% or above, I think the Fed cuts in the first quarter.